Okay, well, thank you for joining tonight. I see you, Pat. I don't know if you see me or not. I see your text. Hopefully you can see the screen. But thank you for everybody for joining this evening. We'll talk about the coronavirus as the most important issue right now that seems to be on top of the mind, and certainly what's driving the market. When you're looking at economic indicators, um, these are the ones I'm reviewing on a daily basis when I'm looking through everything from inflation rates to GDP to sentiment to our to building permits and all the things that the government and other industries put out on a daily basis. It's like one big puzzle, and economics is called the dismal science. And why I enjoy it so much is that there's no perfect green flashing light that says to invest and that the economy is great, or a red light that says, stop and sell everything. It's usually a muddled picture. And as I've always mentioned to our associates at our investment committee meetings, every economic indicator is a backwards looking indicator. There's nothing that can tell you and look into the future. For example, if I pull any one that these are little charts that I'll make. For example, could be on here's GDP versus the CPI, the inflation rate. And when you look at it over a long period of time, usually I like to go back as far back in history because you want to look at things from a historical perspective. And you can see the gray lines here are recession. So these gray shaded areas are recession. And what you'll notice is GDP is often fine right before the recessionary line, and then when we hit the recession, that's when GDP falls. So GDP right now is good. The economy is doing fine. And if I shorten this to say a 20-year chart, you'd notice the same trend. Is usually GDP here was at 5% back before the 2001 collapse, but then GDP fell off, and we hit a recessionary period. Same thing with the financial crisis. Things were pretty good, 2% GDP, and then they fell off significantly during the financial crisis, and then recovered back. The low GDP has been confounding to economists over the last 10, 15 years, and that we've been stuck in this 2% GDP environment. And I think that's where we're going to be going forward for some time. And of course, the big question mark is, are we heading into a recession now? Certainly the bond market's kind of indicating that it's considering that we may have a slowdown. We may see a pull down of GDP, and if we have 2 consecutive quarters there, then that would be an official recession. So the question mark here is the coronavirus going to cause a recession? Now, I don't think that this is the Black Plague, right? So if you look at these things from the perspective of, there was even an interesting piece that I'll share with you here. This one was from JP Morgan. And you can kind of see that, a lot of people, the common flu kills anyone in the United States from 20,000 upwards to 60,000 a year. And right now we've had fortunately, very few deaths, and effectively all in China. We've had none in the US. We've had 53 cases, maybe 54 after today's in California, which scared the market because it wasn't somebody who traveled, we don't know yet, directly from China. So the question mark is how much will this how much will it grow? And then secondly, the death rate for the common flu is 0.1 to 0.3% or so. This one seems to be around 1 to 2%. Really don't know what the death rate is going to be. And of course, we've had more Americans die in automobile accidents in just the past month than have died across the globe from the coronavirus. So it's good to put things in perspective. And although I'm part of the problem, I'll be on Fox Business on Monday morning. I try to be a calming, more reassuring voice while I'm on the news, because if you turn it on now, any of the stations, whether it's Bloomberg or CNBC or Fox News, it's good for ratings to get a lot of sensationalism, and It's not good for investing. And if you kind of see what happened just today in the stock market, you'll notice that the Dow Jones, the futures was down, and the market sold off hard at the beginning. And then as the day went on, it sold off again. And then some buyers came in to the market. It rallied all the way up to, I think it was down about 200 points or so. And then what happened, what you'll notice in the last hour of trading, a huge sell-off down to almost 1,200 points just in the last part of the day. And you'll notice this a lot at the last hour of the day. This is what is really, unfortunately, for long-term investors like us, it exacerbates a lot of the algorithmic trading that's done and a lot of the indexing that's done, and ETFs, the proliferation of ETFs that are out there, exacerbates these moves. When it happens to the positive, people are somewhat happy. When it happens to the negative, investors get very concerned. For the year now, this has been officially a correction, a stock market correction. If you look at, say, the S&P 500, or you can see this significant sell-off. Of a correction is anything more than 10%, and this has been the worst sell-off in a shorter period of time than we've had since the financial crisis. This is very alarming. The financial crisis is still fresh in our minds, even though it was a decade ago. So it's very concerning to a lot of people. So, but if we kind of go back a decade, if I just get a decade chart here, we have had, if I put a date range in going back to, 2008, you'd see that this has been very normal. We've had a lot of these 10% corrections along this very long-term bull market that we've had over the past decade. We've had significant 10% corrections along the way. These are natural and they're normal and they're totally healthy. The question is this going to be a 50% correction? That's the fear that a lot of people have, and that's why we have bonds. If you look at our portfolio, a lot of clients were actually upset that last year, our stocks did terrific, but they're like, Jim, why didn't you put me in more U.S. stocks? Jim, why don't we go more stocks? Oftentimes, those are the same clients who are now saying, why don't we go all to cash? And what we're trying to do in prudent asset allocation really entails making sure. You can see back in 2013, we were at 50% U.S. stocks, and then we had another 10, 12% in international stocks. So our equity allocation at that time was 62%. And slowly during this bull market, what you've seen me do is reduce our equity exposure and increase our bonds in our portfolio to the point where we're almost 50-50 right now. We're effectively, 51%, 52% stocks. And I've been increasing our international exposure too. International stocks have not done well. And those who read the newsletters and the economic reports that I send out quarterly have seen a theme in that I'm finding a lot more value in international stocks than in U.S. stocks. And that's been our trend because the valuation I've been concerned about. And also in the emails that I send out, if you look at our blog, what you'd see is emails and blogs from me talking about, of course, the coronavirus, which I'll talk more about here in a minute. But then, like why Buffett gets it wrong and why I think that indexing is bad and the perils with option strategies where there's so much leverage right now in the market because the stock market's going up and my brethren up here on Wall Street are trying to juice their returns. And now what they have to do is they have to raise cash to cover all the leverage that they have, which exacerbates the upside and exacerbates the downside. And I've said here in this blog, even Buffett can get it wrong. And why I've been warning about this, and you've heard the term MAGA stocks, right? So it's Microsoft, Apple, which we still do own, Amazon, Google, which is Alphabet, these two combined, and Facebook. And some of my more left-wing clients and some of our left-wing analysts have derogatory called this FMAGA because it's MAGA stocks plus Facebook. All right, so you can call it that if you want. But we've been avoiding the stocks. We sold Microsoft last year, I believe, early in the year because of valuation. I started out the first chapter of my book warning about Amazon as the type of stock that we're never going to buy. 100 times earnings, no dividend. I'd rather lose a client after making 27, 28%, whatever we made for our U.S. stocks last year, than have a client go into one of these crazy overly valued stocks and have a fallout. You can see that today, just in today's move. If you look at the MAGA stocks, Microsoft was down 7%. Apple was down 6.5%. Google was down 5%. Amazon was down 5% effectively. So these stocks that are priced to perfection, when perfection is not happening, either due to global disruptions and supply chains changing, or the economy just slowing, they're going to get hit much harder than a stock like that we like a Pepsi or even a Ford, or even some of our distressed positions in companies like B&G Foods or Hanes brand underwear. So from that perspective, what you're seeing is, because these stocks ran up so much last year, they're getting hammered and coming down. If I just show a 1-year chart and put up Microsoft here, you'd see that it just ran up so much. And that's what happens. The stock market in the short term is always a fear and a greed type of thing. And again, at the end of last year, we had plenty of clients saying, geez, why don't we own some of these stocks? Very few, though, especially our clients, that have been with us a very long time. It always is a fear and greed thing, but neither fear nor greed is a strategy, right? We don't want to invest in hope, which is why we prefer dividend stocks, stability of earnings, and companies that have increased their earnings and dividend yield over much longer periods of time. So our strategy, on a day like today, we're down 1.9%. The stock market's down 4.5%. We're down 40% of the downturn on a daily basis today. And that's why we have bonds. And we are starting to, just like this week, we're adding to our positions that are getting beat up as we're finding value. That doesn't mean that, even though I don't think this, if you go to my blog on the coronavirus that I sent out, I put a chart in here, and you can kind of see it here. That's as big as I can make it, I think. You can see that most of the epidemics that have occurred, whether it was swine flu, which happened during the downturn, so it wasn't talked about as much, to the Ebola, which was very scary, because the death rate of Ebola is very, very high. So that's extremely scary type of disease, whereas this one shouldn't be as scary. But when you couple it with some fears about what's going on in the Democratic Party, a lot of Rockefeller Republicans and more moderate Democrats and Wall Street type Democrats are very concerned about the Sanders move. Trump is hoping, of course, for Sanders. He feels he's the easiest component, but even Trump said, hey, I don't know if I could beat, you never know what's going to happen in an election. And so the market doesn't like uncertainty. It'd like to see, candidates more in the middle who aren't going to change and upset the apple cart too much. So there's absolutely some fear coupled with what's going on in the Democratic Party. Those of our North Carolina clients, who are 60% of our clients, have a big opportunity to vote if they're registered Democrats this coming Tuesday, or up to, I think, Saturday, so they can have a major impact on what's going on, as the polls are very, very tight. So I won't get too much into politics, but there's certainly some fear in the market regarding the political environment too. Although this week, this downturn is more driven by the coronavirus, as you saw from today. One case in California, boom, the market, immediately got hit. So I kind of look at these things always from an historical standpoint. So what happens during these things? Usually you get about a 10% downturn in the short term, which is exactly what we've had. Is it going to go down further? It's possible. But as you can see, over longer periods of time, the market starts to trade more on the fundamentals. And as always, what I'm trying to do is not get us whipsawed one way or the other, because we can have a quick recovery, just like we've had in all these others during this tremendously long bull market over the past decade, where we've had a lot, as you can see, just even over the last 5 years, where we've had a very nice move for the stock market, but we've had a lot of very significant sell-offs during this period of time in which investors have been nervous. And I think it's exacerbated because people have fresh in their memory, much like my clients who remember the Great Depression. Some of them are extremely wealthy, have millions of dollars, but they still double dip their tea bags. They have millions of dollars, but are never going to spend even the income that's generated from their portfolio, because growing up with that and remembering breadlines has seared memories into their brains that they're never going to forget. And those of us who went through the financial crisis also remember it. And when we have these downturns, they're very concerned that, hey, maybe this is the next 50% correction, which again is why, from valuation standpoint, why I've been de-risking our portfolio over the last 5 years. Now we have a lot of people on here, so I'm gonna open this up again and see if anybody has any questions, and check my little chat box here and see. We had one good question here on the chat box that says, hey Sean, how you doing? In spite of where the fear of the coronavirus may take the market in the short term, do the fundamentals suggest at this time to invest? And I would say yes, it absolutely does. It is a good time to invest. And if you take just about any of our stocks right now, let's take an extremely beaten down one like Ford Motor Company, which is selling at a very cheap multiple. Let me answer this question. I'm gonna mute everybody again and then answer the question. So you look at Ford Motor Company, very, very cheap multiple, selling at, if you look at the forward times earnings, about 7 times earnings for Ford, with a very nice dividend yield of 8%. And people say, well, is that sustainable? Is that, remember, it's paying out 60 cents. My son once asked a good question. He goes, Dad, how does Ford pay an 8% dividend or 60 cents if the stock price goes down 30%? I said, okay, Max, let's watch this. I said, here's Ford at $7. And let's say Ford's not selling as many trucks in China or in the United States due to the coronavirus or anything else. So let's say Ford's earnings go down by, 20%. Now, Ford, most analysts here on Wall Street, including myself, have estimated earnings between 80 cents on the low end. You can see there's 16 analysts, and a high of $1.58. So you would think that they're still going to be able to pay out their 60-cent dividend, regardless of what their stock price is. So maybe their earnings get cut by, 20%. Maybe they go down 10 cents, 15 cents. They would still have enough money, cash, to pay out their dividend of 60 cents, regardless if the stock price went down to $3. Because in the short term, the stock prices, investors are just selling the stock. So in the short term, the stock market is a voting machine. Everybody is voting on Ford, and today they voted to sell it. I don't care any more than, I just turned 51. Our company just turned 23 years old yesterday. I founded the company 23 years ago. I can't believe it's been 23 years, and we've been to hell and back over this past 23 years. And I continue to say that, I don't know what the stock market is going to do in the short term. When you look at the presentation that I was showing here earlier from our standpoint, I always show the most important slide as our income over time. That, you look at the last 2 decades, our clients never had to go back to work. They went through 2 50% corrections. One we can't show because we weren't GIPS verified early, but we were down 12% during that 50% correction of the early 2000s. But our green triangles here, our clients just kept collecting their income regardless of the ups and downs. This is Ford, and I remember, we were down 35% during this downturn, but our clients' income didn't change. They just kept collecting and either reinvesting the dividend or spending the dividend to fund their retirement. And it's a very boring way to invest, but I'm not going to invest in companies that have crazy valuations and don't pay dividends because, again, I don't like to invest in hope. Kind of like the video we sent out last night, in that we're we're looking for a slower and steadier approach to get our clients through the wars and crises that we've had over the past 2 decades. And I hope to be doing this. I'm not going to wake up tomorrow morning and go, oh my God, the market's up 10%. I'm selling Altrius. And then at noon, with the stock market recovers 1,000 points, go, oh, wait a minute, I'm going to buy Altrius back. Then at the end of the day, if it sells off again as the market sells off, should I, I'm going to sell it again. It's just, I'm going to collect my salary and I'm going to pay my associates at our firm. I don't know what Altrius is worth right now. It's worth probably 10% than it was less if I sold it today than it was if I sold it to JP Morgan today. It's definitely worth 10% less than it was a week ago. But I don't care. I don't care what it's worth. And fortunately for me, I don't have a big blinking light of what it's worth like we do with the stock market. And oftentimes people think of the stock market as if it's this place where we got to get in and out of stocks. It's the completely wrong mentality. Instead, we want to think about it as owning companies, and we're owners in those companies. And to me, if you look at, here's Altrius's portfolio at the beginning of this year. So we own the same stocks and bonds that our clients do. And this is actually our profit sharing plans, 401k, that Chris and Rita and Lauren and Becky and Zach are all invested in. And you can see at the beginning of the year, we had 29% invested, much like most of our clients, in US stocks. That was yielding dividends of 3.8%. And this is a good chunk of our clients right here. This isn't our profit sharing plan. I have to let me redo this so I can show you our Altrius's portfolio here. So at the beginning of the year, Altrius's 401k, which looks very familiar to all of you, I'm sure, we were at 28.2% in US stocks. And that money we had invested was yielding $13,000 of income and 3.8%. Now, watch what happens if I change the date to Altrius to yesterday's close of business. What you'll notice is we own the same stocks and bonds, and the portfolio value you can see was $353,000 at the beginning of the year, and now it's gone down to $330,000. So it's been a significant decline for our stocks along with the market. But what's happened? The yield has gone from 3.8% to 4.3%. The yield's gone up because the price has gone down, but the dollar value is the same. So if our clients had $1 million invested with us, and let me flip back and forth between the two things. At the beginning of this year, our clients could expect that they were going to receive $13,500. Because we've been reinvesting the dividends and interest in our portfolio, it's actually gone up to $14,000. Now, for a lot of our clients, what they're doing is they're taking that $13,000 out to spend and fund their retirement. So should you worry about the decline in your stock prices? Well, my answer would be, of course not. Now, we get paid less because we get paid based on portfolio values, unfortunately. But your stream of income is going to remain exactly the same. Now, the same is true for our international stocks and your international stocks. You'll notice here that as of yesterday, we had $293,000, or 24% of our portfolio invested in international stocks. At the beginning of the year, we had $313,000. I got the wrong one. Yeah, so this is okay. The beginning of the year, we started with $313,000, and now we're at $293,000. It's gone down in value, but we're still getting that $12,000 a year as long as Siemens and Nestle and Mitsubishi and Taiwan Semiconductor and Toyota and Honda don't reduce their dividend. The same is true for our bond portfolios, so that our bonds, As long as we don't have too many in defaults, we know we're going to get that same amount of income, even though the prices of our bonds have stayed relatively flat this year. So our bonds have gone down just a little bit in the last couple of days. You'll notice Altrius's portfolio has $586,000 invested in bonds as of evaluation of yesterday, whereas at the beginning of the year, we had more. We had 547,000. You'll notice again the yield has kind of gone up. It's gone up a little bit, but it hasn't changed very much. Our bonds have stayed relatively flat, but it could have gone down. The bond portfolio certainly could have gone down in the short term, but the income is going to stay the same for our clients. Our clients can still expect that $60,000 a year, or just under 5% a year in dividends and interest. Even if we went down from 1.2 million down to $1 million, that's going to stay the same. Now that begs the question, well, how do you know that's going to happen? Well, you don't know. If you look at any company, let's look at Procter & Gamble. So I'm going to pull up Procter & Gamble here. Or I should pull up Pepsi, because Pepsi is such a good company we've owned for 20 years. And if you look at Procter & Gamble, one thing, we have no control over the price of Procter & Gamble. Procter & Gamble's price is going to fly all over the map, right? So let me pull up Pepsi here. It's a little bit one that we've owned for such a long time. And one of the things that you'll notice is Pepsi was down 4% today. I don't know why, other than the fact that maybe people will drink less Pepsi or eat less Fritos if they're sick. It's unlikely, but it's possible, right? And if you go back all the way to 2000, and let's go all the way back to 2000, you'll notice that Pepsi was making 23 billion, and then 26 billion, and 35 billion, and 43 billion, and the financial crisis came along, and they're still making 43 billion, even though the stock price was down. And one thing you'll notice all the way at the bottom is that Pepsi's dividend, if we go back all the way to 2000, they were paying 14 cents a quarter. Let me do this in red, a little easier to see. And then they were paying 15 cents in 2002, and then 30 cents in 2006, and 45 cents in 2009. And then, as you see, as we go on here, 70 cents in 2015, 75, 81, 93. Now, of course, Pepsi's price all along has just been going like this, up and down, up and down, up and down. But what Pepsi has been doing, more importantly, is growing their dividend, which helps the dividend yield over time, growing their top line revenue over good markets and bad, and minding their expenses to make sure that as they're doing this, that their net income has also continued to grow slowly. And some years they invest a little bit more, and you can see they have some down years, and it helps the final years as things kind of go forward. But their net income over time has grown very steadily. Now, I don't have any control over Pepsi's price, but what I do have control over is investing in companies that have continued to increase their dividend in order to fund our total return over time. Again, it's a very boring way to invest, but it gives you an idea of the style in which we're investing, and this is the great majority of the stocks that we're investing in. The reverse is true for the bonds that we're investing in, because if I invest in a 1% yielding bond or a treasury, and if you look at the rates right now, it's really remarkable. I can't find safe yields for anybody. Incredibly, if you look at the 10-year treasury, let me do this in yellow here. Here's the 10-year across the globe. What you'll see is that the United States is at an all-time low, all-time in our entire American history. It's at 1.275. Some countries like Germany is negative, meaning if you give them $1 million, you have to pay the German government for them to hold your money. Same thing is true with Japan. Same thing is true with France and Switzerland. It's really incredible. We have negative yields across the globe in many countries, and very, very low returns. 0.5% in London, 1.1% in Canada, even Italy is at 1%, which is crazy, right? We're actually higher than Italy. So when you look at yields, I can't put our clients in a 1.5% or 2% North Carolina municipal bond or a 1.2% treasury. because it's effectively guaranteeing failure for you and your retirement. Instead, I'd rather take a little bit more risk and lend money to a company like Briggs & Stratton, the lawnmower company, where we can get a 5 or 6% rate of return over the next year, 2, 3 years, and at least give us the opportunity. Again, high yield bonds, maybe people get nervous about Briggs & Stratton bond. People can see the Briggs & Stratton bond go down. So for example, I'll show you the Altrius bond portfolio here, because we own the same bonds that you do in your portfolio. So if I highlight a company like Briggs & Stratton, I don't know what Briggs & Stratton bond is going to do in the short term. I'm managing the risk by, you can see that we have $1.2 million in our, amongst all of our associates invested in our 401k. But we only have $8,000 invested in Briggs & Stratton because they could go bankrupt on it. So we don't want to put too much in any one bond. But we know that we're going to get a 13% rate of return from Briggs & Stratton as long as they don't go bankrupt between now and December of 2020. So Briggs & Stratton is selling less lawnmowers. Millennials are not buying homes as much. They're not mowing their lawns as much. Briggs & Stratton has shut down a plant, is trying to remain profitable. They're selling, lawnmowers. They're still remaining profitable. We think this is a relatively good investment for our clients at this time. But again, we're not putting too much. If you look at the whole of our bond portfolio right now, it's yielding right around 6% for the great majority of our clients. And that's what we're trying to do. Again, going back to the income side, is get about a 6% rate of return from our bond portfolio, get about a 4% rate of return from our stocks, which gives us a 5% stream of income for our clients, regardless of the ups and downs of the market, which takes me back to this slide here, that yes, we hope to make 7-8% returns, total return, because we need price appreciation, because we need to hedge inflation and taxes. But in the short term, this is going to remain stable regardless of whether we're up 10% or we have a big year like last year and we're up 15%, or if we're down 10% this year. This stream of income is going to stay steady for you to fund your retirement and what you need. For those of us who are younger, I just turned 51 last weekend, and I hope to do this for the next 40 years of my life and be sitting here at 91 saying it's a great opportunity for us to be investing and buying more shares. I'm taking the dividends and interest and reinvesting them and buying more shares of Pepsi in order to increase the income over the next period, which you can see on this slide, which we kind of show that for those of our clients who aren't taking the income, we're just reinvesting those dividends to increase the future cash flow when they do start to take out, when they do retire. Once I get talking about economics, I just start talking. So I'm going to unmute everybody and see. I don't see any other questions on the chat room here. Does anybody have any questions that they'd like to throw out, like me to address?
I'd like to know who that guy is.
There were 4 up there. One was, the female was Pat. I thought he was talking to me.
Oh, Sean, let's see. Sean just asked me another question here. Let's see. How can the growing national debt directly or indirectly impact the U.S. market? And this is a fascinating question. This is one that, as an economist, I love, and not an easy one to answer from the standpoint of debt. So right now, nobody cares about debt, right? Trump wants to lower the Fed to lower interest rates, borrow more money, and spend. The Democrats are spending like crazy. Nobody seems to be concerned about debt at all. Do I think, and along with this, Bruce just asked, do I think the Fed's going to lower rates? And the answer is no. They're going to do everything they can not to, unless the stock market or the economy forces them, because the Federal Reserve wants to be seen as impartial. They don't want to be seen to be helping Trump and lowering rates right now and propping up the stock market, nor do they want to be seen as hurting Trump and raising rates. I was pounding the table while the Fed was raising rates. It was driving me insane. And we had our own debate amongst our analysts on this issue. it was really aggravating to me that the Fed was raising rates when we had very low inflation, which you can see here, and yet the Fed was raising rates and growth is still very low. The Fed was trying to normalize, and the argument was, well, we were increasing rates so that we can decrease them later. It's just stupid, right? So the Fed quickly reversed themselves. They weren't even communicating well. When Powell said, well, we're on autopilot, and I kind of put that slide out a few quarters ago when Powell said, oh, we're on autopilot right now, and we're just going to keep raising rates. We expect 4 rates next year. The market just sold off heavy. But then when he changed his language immediately and then started to reverse the mistake they made by raising rates too quickly, the market stabilized and we had a huge year last year. So I think the Fed wants to try to remain impartial. However, it's watching these things very closely, and there's a lot of debate amongst economists or whether or not they should step in. Remember that right now, if the Fed decreases rates, it's not going to help coronavirus issue, because the coronavirus issue is more about fear. And business spending has not been good. Business spending is certainly coming down if you look at those economic indicators, like the ones I was mentioning earlier. It's the American consumer who's been keeping the economy great. The rest of the world, the consumer hasn't been as good. Well, with the American consumer holding everything up, if the American consumer or the global consumer gets nervous because of coronavirus, it doesn't matter that the Fed's throwing a more pile of money on there, or that interest rates are lower for us to buy a new home or borrow money to buy a new boat. We're not going to do it because we're scared, either because the market's down or because of the coronavirus. So the Fed's not going to have a direct impact like it did last year, where it was just a matter of, oh my gosh, the Fed is, increasing rates and is tone deaf to the global growth slowdown that's occurring. They quickly reversed that and were able to stop that from happening and help the stock market. In this case, I don't think the Fed, even if they do decrease rates, is going to have much of an impact for this particular issue, should the coronavirus issue be, go on longer than we are expecting. And so to get to Sean's question about GDP and debt, if you look at, let me go back to the economic library here for all these different charts that I make. If you look at the Fed balance sheet and government loan, we are at astronomical levels here, just since the financial crisis and all the quantitative easing. And of course, as you can see here, yields have come down to effectively zero. Right, we've gone very, very low from what the 10-year bond has done and what the Federal Reserve has done to cut rates. The question mark here is, what is the right amount of debt for a country to own? Everybody knows the answer to what got us out of the Great Depression. If I asked, hey, what got us out of the Great Depression, everybody would answer, World War II, right? And what happened was we had, at that time, 100% debt to GDP ratio. If you go way, way back, here's 1950. So I sent this slide out during the last quarter, and Sean's question, and a lot of conservatives, fiscal conservatives, if there are any left on the planet, they're concerned, like, is this too much debt? Now remember, even when we've been at 30% debt to GDP, nobody wants to go back to the Carter years. We had a horrific recession. You can remember, some of us can remember, I wasn't too old, but 1973-74 was a horrible recession. So you can see these green lines. We had terrible recessions, even when we had very low debt. Ireland went to the brink of bankruptcy. Iceland went to bankruptcy with 30% debt to GDP. This is really more about the power of the taxing authority of the country, where people get, Japan has 200% debt to GDP. Nobody's concerned about Japan because their economy has been strong enough where people feel like, okay, we'll lend them that much money. On an individual, if you think about it, Sean, if you think about it from your standpoint, if you're a young lawyer or a doctor, and let's say you're making $300,000 a year, and you come out of law school or medical school, and you're a bank, if I'm Bank of America, how much money would I lend that young lawyer or young doctor right out of med school to buy a house who's making $300,000? And remember, that doctor or lawyer has about $150,000 of medical school debt or law school debt that he has to repay. So how much would you lend that young doctor to buy a new house for him and his wife? And the answer, of course, for the bank is about $1 million. Because the banks look at it like, banks sit there and say, all right, I've got a doctor here who's got a safe income of $300,000 a year. And I'll lend him 3 times what his income is to buy his new home for his debt to income ratio, just like America's debt to GDP. So that seems to be the going rate. Is that the right rate? Probably. If you think about a lot of the companies we own, this is very similar. Now, if Bank of America gave him a 5-year adjustable rate mortgage and said, Sean, your adjustable rate mortgage is up. The mortgage is up. Give us the $1 million back that we lent you for your house. You would say, I don't have $1 million. I'm making $300,000 a year. I could pay the $7,000 a month mortgage, but I cannot pay you the $1 million back because I've got $150,000 of debt. I finally bought a car. We can't do that. That's like most of the companies that we lend money to. Their cash flow is like that young doctor. They've got great cash flow. They can't pay back the $500 million they're borrowing, like Briggs & Stratton Lawnmower Company, but they can continue to pay the interest on their debt. So the great question, if you take this from a micro example of the young doctor or a small business and turn it into a macro question, should America be borrowing more money? Capitalism and economics is a new science. It's only 250, 300 years old. So the great question for economists is maybe we'll find out 50 years from now that 300 times leverage is good number. I tend to like to be in this historical norm somewhere between 40 to 60 because I don't want to get out of this range. And here in America, and China doesn't have this problem, and India doesn't have this problem. Here in America, this is entitlements. So unless we get rid of entitlements in America or stop doing a lot of spending, this issue is not going away. I don't care if it's Republican or Democrat. This extra spending is all due to entitlement. Social Security is easy to fix, right? We just raise the age, but Medicare is very tough. I kind of talk about the miracle of capitalism. If I don't have a can of peas here, but next time I'll grab my candle here. Next time you go into the supermarket, just grab a can of peas or a candle or something and look at the miracle of that can of peas. Think of the farmer who had to grow it, the trucks that had to drive it, the supermarkets that have to sell it, the miners who had to make the metal to go into that can, and we get it for $1. Now, not everybody can afford that $1 can of peas, and we have food stamps and other things, but to me, insurance has gone the wrong way, right? If I was king for a day, I would just make it so that America went back to a cash system, just like we do with orthodontics or LASIK eye surgery is amazing. It's a miracle, right? And those prices have come down 80% because we pay that for cash when we want that. Instead of buying glasses because I'm afraid of LASIK, I'll just buy the glasses. But that's kept prices and costs down. But not everybody can afford LASIK. Does everybody have a right to LASIK? Is it a human right? That's a whole nother question, and it's difficult. But when you walk into that supermarket, if I just paid a $25 deductible to the cash register, and I walked in and didn't even know what was in the can of peas or how much that can of peas cost, and I just put a cart full of stuff and just checked out, and then got a bill for $80 when I got home a month later, there's no incentive. That can of peas would be $20 because we can't, and that's our medical system. That's the problem with the Medicare system, and we've gotten worse and worse. So neither Republicans nor Democrats who say they can control costs, and it's the evil healthcare companies, they're both full of baloney. There's no way you can control costs unless we go back more to a cash type system and make insurance for medical costs, just like we do for an automobile and a home. And whether or not we require everybody to do it, I think is a good idea. The Democrats are right in that sense that force everybody, just like we do with auto insurance. If you drive a car, you got to have auto insurance, period. That's the law. Same thing with medical insurance. Force everybody to pay in. Unfortunately, though, we're going more the route of a different system now. And what you're going to see is this continued growth. As a patriot, these things I worry about in America. As a capitalist, I don't, because I know that capitalism will find an outlet somewhere around the globe for Pepsi to sell its products in India, China, Latin America, and countries where this isn't an issue, where too much money may be going to one particular ill-advised project, which is, having wasted tons and tons of money as a government employee, as a Marine pilot, where I was just spewing out gas at the back just because we had to fly a bunch of hours. I saw firsthand what government waste does. So I'm not a fan of it. However, I'm not answering your question directly here, Sean, because it's a big question mark of whether or not we should be actually borrowing more. I'm not going to the modern portfolio theory, which it doesn't matter at all, because it does. We just don't know matter where. It matters at 30% sometimes, where some countries that don't have as much taxing authority, like Ireland and Iceland, can go under at 30%. And again, to show, nobody wants the Carter years, but we were at 30% when we went through these horrific recessions, 73, 74, and then again toward and how do we get out of that? Well, huge government spending. Everybody, conservatives, my conservative friends, love Reagan, and it was great while I was in the military. And we got out of that recession by deficit spending, right? So that's how we got out of it. So spending is good when nobody else is spending. Keynes is right in that when you go through recessions, you need government spending to get us out of that recession. You can see only government was spending during this crisis. You and I weren't going out there and spending. Businesses weren't spending during the financial crisis. It took government spending to get us out of the financial crisis. And with low rates, I said at that time, I thought rates were going to be lower for longer, for a decade. I didn't think we'd still be at 1.5% that we're at. To me, it's very, very low. And it's a challenge to me to be forced to take some risk for our clients to get you the returns you need. Had another question here on the chat line. If the fear subsides and this correction levels out, do you see the market returning to record highs in the not too distant future? This is the question that Fox News asked me, and I give them the answer without giving them an answer, because they want you to say, yes, absolutely, the stock market's going to recover, we're oversold, or no, this is much more fear, we're headed for lower. The reality of it is nobody knows in the short term. What I do believe in, as Warren Buffett was saying, is that we want to be long-term owners of Ford and Pepsi and Procter & Gamble. And over longer periods of time, this thing is going to be a blip, just like the other 10 and even 15%. Oh, my wife's birthday coming up here. Better not forget that. So, just like the corrections that we've had over the last decade and 20 years, those 10% corrections were quite small and weren't felt. Now looking back, it's easy to look back and say, oh, that wasn't that bad. Of course, if you go back to 1999, there were some severe 50% stock market corrections during that period of time. Oh, I've lost my pipper here, so it happens sometimes. But you can see we went through some terrible after the post 2000. That was a 50% stock market correction that I lived through, and then another 50% correction that we lived through during the financial crisis. And since then, it's been straight up, but it hasn't been. If you remember all those horrible downturns, the question mark is this going to continue or not? And the answer is, I really don't know. I think we are conservatively positioned right now at 50-50 stock to bond. I think we should be continuing to buy because I think that the economy is still quite resilient. And I think the most likely case is that we do find, and that the coronavirus is much like most of the other epidemics and pandemics that we've had over the last few decades, and that it won't be as longer lasting. I'm going to open this up again to questions here. It must be boring because we've had some people pull off here. Let me throw it out. You can send it via the chat line if you like, or just yell out. I think I've unmuted everybody here. If you want to yell out a question. Other questions? see. Mr. Arnold, did I get your 3 questions? Let's see. We talked about valuations were so high, investors locking in profits. That's definitely happening, and due to the leverage they're selling off. Fear of revenue declines related to coronavirus is definitely a major part of this, and including, I think, a little bit of this is the fear of what's going on with the Democratic. If you look at, if you talk about politics here, if you look at Real Clear Politics, is a great website, and you can bet on this stuff now, which is crazy. So you'll see the odds of a Sanders election. If you go, you can see the betting odds right here in the right hand corner. You can see right now it's at almost 54% that Sanders is going to get the nomination for the Democratic side of the House, and then there'll start to be polls on that. And if you look at the betting odds, there'll start to be polls on Trump versus whoever the primary is, and you can see way back, Sanders wasn't even people thought, no, he's too crazy, he's too far left. He's only 14%. Then he went all the way down to 7% odds back in October. And this has changed rapidly. After Super Tuesday, I think right now, if I was putting the odds on, I'd put it at 75, 80% Sanders, simply because he's going to have so many delegates. And much like the situation was with Trump, in that Trump was able to get, even though he didn't have the majority, he was able to get enough delegates where the Republican Party got enough. That's likely to be the case too with Sanders. So, is Trump going to beat Sanders? Is that going to be good or bad for the market? Certainly the market's the market usually likes things the way they are. Bloomberg's odds were much higher, up to 34% just a month or so ago, but his debate performances knocked his all the way down to even recently down to 17.8%, probably because Biden's numbers have come up a little bit in South Carolina. You can see Biden's actually now came all the way off of 9% all the way up to 22% because of his polls in South Carolina. So, these things are tough to handicap, but the market will kind of give you a good betting at, Las Vegas will give you pretty good odds on these things, at least to see, and you can see how rapidly they can change too, as time goes on. So we'll see. The worst case scenario for a lot of people is a Sanders victory, but remember, there's a lot of moderate Democrats, and even if the Senate shifted, that aren't going to go for a lot of the programs that Bernie has advocated for. I don't see Bernie as a soft and cuddly Nordic type of democratic socialist. His way is very strong-handed and my way or the highway, and that's probably why he, kind of like Senator Cruz when he was running, didn't have a lot of friends in the Senate. And one of my friends is Senator Young of Indiana, and who gets along very well with Senator Booker up here, whom I know well, and Todd, Senator Young, and Senator Booker get along well. It's oftentimes the guys you see on TV are the ones who are extreme. It's not as bad as you think in Congress. There are some that still get along quite well and talk to one another and get things done, like the criminal reform that President Trump just passed on a bipartisan measure. So there's some things still getting done, although this year there won't be too much getting done on the economic side as the election kind of heats up more and more. I'll open this up again here, see if there's any other questions. Let me check the chat line again here quick. Chat line's kind of hard for me to see too. So looks like no more in the chat room here. Anybody else want to throw anything out? Nothing?
Jim, are you concerned about the earnings for companies that are down so far being able to maintain the dividend that they're paying? The companies that we own.
Yeah, I'm not. There are very few. The great majority of our companies, what I screen for is, as you can see, like with Pepsi as an example, where I want at least 50% coverage on the dividend. So, for example, let's say that Pepsi's paying out, $4 What I'm looking for is earnings of $8 a share, and that's the great majority of our companies. I'll occasionally buy a company that's distressed where I think the dividend may get cut. Pitney Bowes is an example of one of those where we won't own too many of those because there's so much short interest. What you often see in certain stocks that are used today is there's a direct correlation, and this angers me about the hedge fund guys, is that there's this great proliferation of long short hedge fund managers who will go long one stock that's a momentum stock like Microsoft, and they'll go short the stock. So you can see as Pitney Bowes' stock price is declining, the short interest is going up. They're just piling on the other side. And, on a day like today, Pitney Bowes' contrarian position was actually one of our only two stocks that were up. And that's why I kind of like them. A lot of times clients don't like stocks that are going down, but they tend to be non-correlated to the market. What's funny is I show my staff this all the time. When you look at analyst predictions on companies, you'll notice that, let's take Pitney Bowes as an example. All the analysts, my friends up here on Wall Street, all the really smart Ivy Leaguers, the stock price is up. They love it, right? So 60% of analysts on Wall Street back in 2008 thought Pitney Bowes was a great stock. Then after the stock declines massively, then they're like, oh, wait a minute, it's a sell, or it's a hold, with a great majority of them. And then the stock price starts to rally. And look at analysts. After the stock rallies, then 50% of them love it again. These are the really, real smart Wall Street Ivy Leaguers. And then the stock price is declining, and then they go, oh no, now it's a strong sell again. Wall Street analysts, the guys you see on TV, they're always chasing their tail. They're just stupid. I mean, they're very highly intelligent people, go to the best schools, but to me, I'll take a farmer any day to understand options better because a farmer understands really what he's hedging rather than a Wall Street trader who just doesn't get it, in my opinion. So that's where people talk about the flyover country. I'm like, you don't get it. Flyover country, people understand how to run a business because a lot of them are business owners rather than the guys just working for JP Morgan collecting a salary. So the great majority of our stocks, to answer your question, is there's coverage. There's plenty of room where even if their earnings went down 20%, they still have room to pay their dividend. I'm slowly losing everybody here now. I must be very boring. I'm even losing staff. Chris asked the question, how do the companies notify you that they plan to lower their dividend rate? Good question, Chris. They don't usually until they do. What will happen is you'll see a company like Pepsi basically just come out, and I may expect them wrongly to absolutely not, because you have a company like Pepsi that hasn't lowered it in 30 years, and they come out there and say, you know what, we're going to lower it to 80 cents. I'll see it immediately, but I'm knowing it when you're knowing it, and I get I get aggravated. I'm like, all right, they're cutting their dividend. But then the second question I make is, do we sell it, or are they cutting it for the right reasons? Are they cutting their dividend? Is their yield still very high? And are they cutting it because they're closing a particular plant to lay some people off, or they're investing in something and minding their cash right? And if the answer is that I think that they're doing it for the right reasons, then that's okay. I mean, Pepsi's a great company. I actually wrote a note to the CEO of Pepsi back in like 2002, because he happened to be like me. He was a Naval Academy grad, and I wrote him a note and said, thanks for taking care of our clients and shareholders all the years you've been CEO. He wrote me a note back. He said, go Navy, class of 91. I'm class of whatever class he was, 67. And it wasn't a mistake, by the way, that his CFO, Ingenuity, who did such a great job for us, was Indian, because Pepsi saw that the growth of the company was really necessary in places overseas, like India. And she did a remarkable job of taking when he retired, of putting his CFO in the CEO role. And Rob just made a good point. One of our advisors, financial advisors, just said, hey, it may be a good thing to talk about how many cut during the financial crisis. And the answer was very, very few of our companies cut their dividend even during the financial crisis, which was horrific, right? I remember a company like Dow was one that did cut their dividend, but we actually bought more because they lost a big contract in Saudi Arabia, and it made sense to me the reason they were cutting their dividend, and it turned out great for us to not sell Dow at that time. But the great majority of our companies, you can the answer to Rob's question goes back to, to me, the most important slide is that during the financial crisis, which you can see here, even though the stock market was going down, our clients, you see how the yield went up significantly. And on a real basis, you could see in 2008, our client's income was on that $1 million was right around 50-something thousand, and it declined just a little fraction there during the financial crisis, where some clients tightened up a little bit, but we were still getting right around 5% on our money during the financial crisis. So thanks for pointing that out, Rob. That's a good thing to point out. During that horrific 50% sell-off and a terrible recession that we went through which was the worst since the Great Depression. Our companies held up very well for our clients, and none of them had to go back to work, except those who were, if they were spending 10-15% a year, that I can't make those kind of returns. But if they stuck to, the 4 or 5% a year, which was the 99% of our clients, then, they didn't have to change their lifestyle one iota. I'll open this up again here for any other questions. I always get the best questions from people to talk about that way. Did I answer your question, Chris? I hope I did. You said okay. All right, thanks. Enjoying life in the less tax state of Delaware. I tell you, New Jersey's talking about increasing on the high end to 11%. There's going to be a great exodus to Pennsylvania, more of an exodus to Pennsylvania, which is only at 3%, or people going up to New Hampshire, much like North Carolina was experiencing, to South Carolina and Tennessee. Tennessee's at 0%, and South Carolina, and the former governor of North Carolina, recognized that, because he was the mayor of Charlotte, and he immediately, in the Republican Senate and Assembly, lowered rates in North Carolina, so that we had, and now, of course, there's a great influx of, to the chagrin of some of my conservative clients, a lot of Yankees, a lot of us damn Yankees coming down to North Carolina and turning the state more purple, more progressive, because it's a little bit more, some more of a liberal influence on North Carolina politics. So really important. So get out there and vote this Saturday before the early voting, or on Tuesday. Very exciting election coming up. Any other questions? Well, thank you so much for attending tonight, and I hope this was helpful a little bit to kind of give you an idea of our strategy and how we're going to weather this. I don't know if there's going to be more downturn to come, of course, in the short term. There's certainly going to be some volatility. I think next week we may see some stabilization, because this thing is really sold off heavy, barring a massive pandemic where it just starts getting out of control. I think things will stabilize into next week in the short term, my guess at least. But thank you very much for attending tonight. If you have any other questions, always feel free to give us a call anytime, or shoot me an email. If you email me at 11 o'clock on a Friday night, I'll email you back on 11 o'clock on a Friday night. All right, take care.